Have you ever entered an option trade that looked perfect only to watch your profit swing widely after a small move in the stock? The reason may not have been the delta, it may have been gamma. Gamma is one of the least understood option Greeks, yet it is one of the most important for managing risk. It determines how quickly your delta changes as the market moves and can dramatically affect your profits or losses. In this video, I'm going to explain how gamma works in its simple terms and to discuss how it influences popular option strategies. Hey, it's Frank Nagy. Welcome to my channel where we help investors understand various market environments, risk management, and alternative investment strategies. If you're new here, subscribe to my channel and hit that like button. So what is gamma? Gamma measures how much an option's delta changes when the underlying stock moves by 1 point. Think of delta as your car speed. Gamma is how quickly that speed changes when you press the accelerator. For example, suppose an option has a delta of 0.40 and a gamma of 0.08. If that stock rises by $1, the delta increases from 0.40 to approximately 0.48. If the stock rises another dollar, delta becomes roughly 0.56. Notice something important? Delta isn't fixed. It constantly changes, and gamma tells how much and how quickly those changes happen. The higher the gamma, the faster delta changes. Many beginner traders focus only on delta, but gamma determines how predictable delta remains. High gamma means that your position becomes increasingly directional with every market move. Small price changes can become quick gains and also large losses. This is especially important if you're selling options. When you're shorting an option with high gamma, your risk can increase rapidly during large market moves. That's why professional traders monitor gamma every day. In fact, sometimes every hour. It's one of the key measures of a portfolio risk. This is one of many strategies Theta Bridge Capital Management applies when managing non-directional investment portfolios with a focus on risk management and market analysis. The firm's objective is to develop structured investment approaches grounded in portfolio construction, risk control, and long-term capital growth. Gamma isn't constant. It changes based on two main factors. As expiration approaches, gamma increases dramatically. This is especially true during the final week before expiration. Gamma is also highest when it's at the money options. Options that are deep in the money, which is higher than the strike price, or far out of the money, typically have much lower gamma. That's why many positions can suddenly become much more sensitive near expiration. Now let's compare positive versus negative gamma. Long options have positive gamma. That includes long calls, long puts, debit spreads, and many calendars and diagonal positions. Positive gamma means your delta adjusts in your favor as price moves. If the market rises, your delta becomes more positive. If the market falls, delta becomes more negative, and this helps long option positions react favorably to large market moves. Short options have negative gamma. Examples include short calls, short puts, and Iron Condors. Negative gamma works against you. As the market moves, your delta becomes increasingly unfavorable. That's why short option sellers often experience rapidly increasing losses during sharp movements. Understanding gamma helps explain why different strategies behave differently. Professional traders don't just ask, am I bullish or bearish? They also ask, how much gamma am I carrying? Because gamma often determines how stressful or how smooth the trade becomes. Gamma may seem like an advanced topic, but it actually is one of the most valuable risk management tools in option trading. Gamma measures how quickly delta changes. Higher gamma means greater sensitivity to price movement, and gamma generally increases as expiration approaches, especially for at-the-money options. If you understand gamma, you'll better understand why options behave the way they do, and you'll be able to manage them much more effectively. To learn more about Theta Bridge Capital Management and our investment strategies, risk management approach, and portfolio construction process, click on the links below in the description box.